All right, so here is where we actually apply the insights from the previous lecture to cost of capital calculations. We're going to use capital asset pricing model, the CAPM, to obtain the cost of capital for capital budgeting projects. This is actually quite an interesting way of doing this because we're assuming that an investment project is exposed to the market, so there's going to be some insight out there in the market that is going to be helpful with regards to determining the risk of a particular project, and that risk is going to determine how much return investors are going to require on this market. So the lining of the logic is simply um, we have a market exposed investment project, and as a result, we're going to use insights from the market in order to determine the risk of the project. Okay, now we basically view an asset, view a project, a capital budgeting project, as a risky asset, right? And then if that is so, that risky asset is going to have its own beta, and once it has its own beta, we're able to calculate the risk premium for that particular asset by just multiplying that beta by the market price of risk, right? RM minus RF. And then once we add that to the risk-free risk, it basically inflating the required return by the opportunity cost of not consuming today rather investing, and then there we go. That's a cost of capital. So R sub J here is going to be our cost of capital for a particular project. Let me make sure my pen works. For some reason it is not working. Oops. Okay. You know what? Never mind. So let's see an example. A capital budgeting project cost $2,300, and the expected return is $410 per year. Okay. And it's going to take a form of a perpetuity. All right, so basically it means that once you invest in this project, you're going to get $410 forever, every year. Okay, we have a risk rate of 7%, a market rate of return is 14%, so that's basically the average return on S&P 500 if you'd like. And then the beta for this particular project is 1.3. We want to see what are the net present value and the expected return on project. So note that we are distinguishing the cost of capital from expected return. That's a very, very important point here. Okay, so let's start with the net present value. To determine the net present value, we must first come up with some discount rate, which in this case is going to be the cost of capital, and for that we're going to use the CAPM, right? Just plug in numbers there, and then 16.1% is going to be our cost of capital for this particular project. Okay, so going forward, we have to determine the present value of future cash flows and then subtract the cost of acquiring this investment, which is $2,300. All right, the present value is simple. It's a perpetuity, so you're just going to take the perpetual cash flows and divide them by your required return, which is 16.1%. So that's the present value of revenues or benefits, things like that. And then you want to subtract the cost of acquiring this, which is going to take us a net present value of 246.58. All right. Now, in order to get the expected return, which we're going to dub internal rate of revenue, internal rate of return here, you're just going to take the cost that you have to make in order to invest in this thing, and then you're going to have the annual proceeds from this investment, right? Just divide the proceeds by the cost that you incur at the very beginning. So it's some sort of, similar to the annual yield calculation. So note that the expected return here is greater than the required return. So this is basically consistent with the argument that we just had. A positive net present value project that adds to the value of the company is going to have an expected rate of return or internal rate of return that exceeds its cost of capital. All right. Now let's talk a little more about risk return trade-off. So if you think about the value project, it's going to depend on its future cash flows and the cost of capital, obviously, right? So the larger the future cash flows, the greater the value of the project. The larger the cost of capital, the smaller the value of the project, right? Because the cost of capital goes in the denominator. So it's important to notice that as a result, that projects with larger future expected cash flows are not necessarily more valuable, because you always can say, well, there is typically greater risk associated with greater payoff. So if you see a project that has larger expected future cash flows, you can also imagine that there's larger risk associated with that project. So it's important to realize that there exists this offsetting impact that could actually wipe out the positive impact of increased um, future cash flows. All right. Um, so that's why we really have to be careful about cost of capital calculations. Okay. Now let's move on to a related um, concept, which is going to seem very different from what we just did. So when you think about CAPM, you're going to basically conclude that whatever non-diversifiable risk there is going to be important in order to determine the risk of a project. How much a project's risk is tied, or how strongly that risk is tied to the risk of the market, is basically the extent of non-diversifiable risk. So the greater that extent is, you're going to say, okay, this project is more risky, so I'm going to require more return on this investment. Okay, now the non-diversifiable risk um, could be thought as two parts. Okay, especially the part that is borne by stockholders. There is this operating risk, which results from operating leverage, and there is financial risk, which is driven by financial leverage. Okay, so just to make sure everyone knows what leverage is, um, high school physics, I have a weight W here. I can create a leverage so that I can uh, handle this easily. Right now, the length of this part really matters for how much this W could be, right? If this weight increases and I basically move the base closer to W, I will have a longer leverage and I will be stronger when it comes to moving the weight W, right? So that's basically the same when it comes to financial structure of a firm. You want an investment. Investment is W. So the more you can, the more leverage you have, then you basically have more funds to invest in that particular project. Okay, so that's why we have this leverage thing. So the operating leverage, though, is kind of different. So I'm going to show you what operating leverage is first, and then we move on to financial leverage. So operating leverage arises from the mix of fixed versus variable costs of production. So I'm sure most of you have already taken courses where fixed costs versus variable costs were discussed. Okay, so it's all about the technology. So you can think of a particular technology that is going to require a lot of fixed cost, is highly automated, and is going to rely on very little variable costs, say, for example, labor wages. Okay, in contrast, you could produce the same output, but then rely more on labor but less on capital. So typically the reason a fixed capital, typically the reason for going with a automated platform is that it's cheaper in terms of average production cost, right? But the downside is you're stuck with that technology for a long time. Okay, that's going to create risk. Okay, it's going to have an upside risk, which basically says that if the market is good, demand is very high, you're going to enjoy a lot of profits because the average cost of production is low. You have an automated factory. But on the other hand, if the demand goes too low, then you're stuck with all this infrastructure, all the machines, robots, and all those things. But then you're not producing as much, right? So you're going to miss out on that front. So that risk is actually quite important because had you had chosen the other platform with high labor intensity, then you could simply lay off workers if the demand would go down, and as a result, you wouldn't incur as much loss in times of low demand. So to sketch that out, I'm going to have a simple example here. So Jewel Plastic plans to make plastic jewel cases for Blu-ray discs. There are packets of 10 cases that can be sold for $5. All right, so the market is extremely elastic. The price is fixed, so whatever you produce, you can sell. Okay, so let that sort of thing. Now, two alternative manufacturing technologies are available. Right, there is Plan A that's going to require $6,000 of fixed investment, and then it's going to be associated with a variable cost of $2 per unit. So basically, per packet that you produce, there's a two unit cost to that. Plan B is more automated, so the fixed cost is higher. You have more robots, more machinery, but then less variable costs. You probably need labor only for distribution. All the production is done by machines. So that's why your variable cost per unit is only one. All right? So let's ignore the taxes and try to calculate the profits here. Suppose that, well, profits are going to be sales minus cost. That's obvious. Now, at the sales level of 50,000, that's what I'm going to take as my initial point. The profits on the Plan A are going to be 50,000 minus the margin per unit, times margin per unit. And margin per unit is going to be 5 minus 2, right? Because 5 is what you make, the average revenue, and 2 is the average cost. So the average margin is $3 per unit. Now, what's the cost that you've incurred to actually put together this factory? It's $60,000. So this means that at this particular level of production, your profit is $90,000. Under Plan B, though, it's going to be different. So you're going to have 50K times 5 minus 1 this time, right? And then minus, was it 100? Yes. So let me actually go check. Yes. Minus, let me see if I can erase this. Yes. Minus 100K, right? Which is going to be actually 100K. So this is greater than this. Okay, so it says that at the particular level, it's good to go with Plan B. So that sounds like a choice. But what about other levels of demand? What about other levels of production? So you actually can think about plotting the profit as a function of units produced for Plant A and Plan A and Plan B, and then this is what you get. So for Plan B, you're going to have a kind of a steep increase in units of production. And the reason is what? The reason is the marginal benefit from an additional unit of production is higher, is 4 units with Plan B. But with Plan A, because you make a $2 cost each unit that you produce, with the fixed price of 5, the margin is only 3. So the slope at which profit goes up is lower. All right? But that's not necessarily bad. What if the market does terribly? What if the market is down to 30,000? If market is down to 30,000, say from 50,000, what's going to happen to Plan B is that, it's going to lose this much of profits. But with Plan A, the losses, I'm sorry, this is plan B, so let me fix that. Oops. Yes. This is how much plan B loses, but with plan A, the loss is going to be only this much. Okay, so that means that there is some sort of risk going on here. When you attach yourself to a lot of fixed assets, you basically um, are stuck with the corresponding costs, and as a result, if your sales vary by a lot, the changes or the loss that you're going to be hit by is going to be much bigger. So this is what we call operating leverage. The more you rely on fixed asset or the fixed costs in order to make your production line, the higher your operating leverage. Now, operating leverage is going to affect the risk of an investment. It's going to be unique for each investment. So a pizza place is going to have its own unique operating leverage compared to say, a nanotechnology research center, right? But what matters is that operating leverage is going to affect both diversifiable and undiversifiable risk. And because it affects the non-diversifiable risk, it's going to affect the cost of capital, right? Recall that cost of capital based on CAPM is related to non-diversifiable risk. Now, if you have a higher non-diversifiable risk, you have a larger beta, and then as a result, due to CAPM's structure, you're going to have a higher cost of capital. Okay. Um, Nonetheless, the firm's choice of operating leverage are typically limited. So there's not thousands and thousands of different ways you can produce something. Just a few typical and identifiable alternatives out there, and you're basically stuck with that. So it's kind of easy to identify whether the operating leverage of two projects are significantly different, and then based on that you can determine whether the cost of capital associated with the two projects are going to be significantly different. All right, so I'm going to pause here and move on to the next video for financial leverage. Okay.